This is Financially Fit Business with Ruth King.
Welcome to the Financially Fit Business Podcast. Here you discover ideas, tactics, news, and information that matters to the health of your business or your clients' businesses. I'm your host, Ruth King. Here is how we will help you increase the financial fitness of your business today. Subtle changes in P&L and balance sheet trends mean a lot. It's best to pay attention to these small changes and resolve them before they become major cash flow, productivity, or profitability problems. In the last episodes, I covered little changes in the overall profit and loss trends, changes in gross margins, and changes in productivity. I covered little changes in the balance sheet current ratio and asset test. In this episode, I covered the balance sheet accounts receivable to accounts payable changes. Let's get started. The accounts receivable to accounts payable ratios and trends are a little bit tricky because they can signify increased billing, but they also can signify increased receivable days, so to speak. And when we get to the usage ratios, I'll be covering those in detail. But the two ratios are really linked together. So the issue that you've got is that you have to figure out which it is. So it's really easy to tell if your client or your company has just billed a whole lot of revenues for work that they've completed. You should see this ratio jump, assuming that all that work was profitable. The reality of it is that if that is what is happening, this ratio going up is just fine. However, if it's a situation where billing and revenues are somewhat consistent and this ratio keeps going up, then there probably is a collection problem. And you should be able to see that in the receivable days. So this one, you have to kind of be a detective and you have to look at the usage ratios, which I'll cover in a later podcast. So the reality of it is figure out which it is. Okay. So let's talk about the monthly ratios. This is where you should instantly see the increases in billing. So for example, one of my clients does a lot of maintenance projects for their clients and their customers. And these maintenance projects are billed every quarter. So every quarter, like clockwork in January, April, July, and October, I see increased billings, which means increased accounts receivable to accounts payable trends in their monthly financial statements, in their monthly, and their monthly ratio data and their graphs. The thing is that I know it and they know it. So we look to make sure it's still happening. Once you get a pattern, you know that, okay, every quarter, we're going to have 1 month where the receivables are going to be really, really higher than normal. And we should expect to see this in the graphs for our monthly receivables to payables. We can then look at the trailing numbers because even though the monthlies are going up every quarter, the trailing numbers and the trailing graphs, remember, are a year's worth of data taken a month at a time. So we should see those numbers actually just being fairly flat or increasing if the number of maintenance agreements and maintenance contracts is increasing. So the two graphs, the monthly and the trailing, actually look at each other in terms of, okay, this is what's going on here. It makes sense. We're seeing increases every single quarter, and then it drops, the ratio and the trends drop, and then it goes up, and then it goes down, and then it goes up, and then it goes down. And the trailing is increasing because the number of maintenance contracts that they have is increasing. So that's our check to make sure that maintenance is actually increasing when the trailing graph is also increasing. So that's one way to really and truly look at it. If you have clients or you're in a business that's truly seasonal, you're going to see monthly up and down, up and down, up and down, up and down because of the billing and the revenues that you're bringing in every single month. Then the trailing totally, evens out all of those monthly seasonalities. And you should see increasing receivables to payables trend lines if the revenues are starting to increase. And you'll also see this on the P&L graphs, which we've also talked about. So all these graphs really and truly interact with each other very well. One should support what the other ones are saying. And if you have a client or business that has very different revenue streams, like product A has revenue stream number one, and product B has a different revenue stream, and product C has an even different revenue streams, you may see monthly fluctuations depending upon which of those products got sold more that particular month and contributed that much more to revenue. And so at that point, you would expect to see up and down, up and down, up and down in the monthly receivables to payables graph. But in the trailing, depending upon the total mix of business, you would hopefully see that receivables to payables ratio would be going fairly consistent, or even going up if the revenues are going up. So again, you can see that in the P&L graphs, but you also should be able to see it here. Now, some other things that have been really crazy and affect this graph is if you get retainage. If any of your clients are in construction jobs and in the construction industry, and they get $1 million in retainage in the door, I normally don't put retainage in accounts receivable. I just look at it from the trade perspective. And retainage, we never know when we're going to get it or not. So if you've included retainage in your accounts receivable to accounts payable ratio, and the company gets a $1 million check, so to speak, guess what? Receivables just crash. And so as a result of that, this ratio will then also crash. And you're going to see the drop also in the trailing and the long-term ratios and long-term trends. However, that is something that you have to decide whether you're going to do or not, because I find that retainage, you never know when you're going to get it. So I don't trust, and I use the word trust, when we're going to get it and when the company's going to get it. So I try to look at receivables without retainage in it. Is the ratio still decent? And can they pay their bills without having to worry about getting this retainage? Retainage becomes a really cool thing to get. And we'll talk more about that when we come back from break. Thanks for listening to the Financially Fit Business Podcast. We'll be right back.
Financial advisory services are the key to the longevity of the accounting profession. If you want to get started providing advisory services or want a review of a finance course you took in college, Ruth King's manual, Understanding Financial Trends Analysis, might be your first step. This manual gives you the information you need to help your clients with their financial statements. A great start or addition to your financial advisory practice. You help them with clarity on their business's financial health, the ability to spot impending issues and resolve them before they become a major crisis. Less stress and sleepless nights worrying about the financial part of their business. Your Financial Statement Trends Analysis Manual is the reference guide. What do you want in your financial advisory services practice? Click on the link below for more information and to order.
We're back. Thanks for listening to the Financially Fit Business Podcast. And before the break, we started talking about retainage and how it affects the accounts receivable to accounts payable ratios and trends. And if the company, and if one of your clients and the company gets a huge retainage check, guess what? Most of the time they pay their payables off, which makes a whole lot of sense to do. And so this ratio then gets huge because the denominator is lower and the numerator stays the same, because if you've not included retainage into the receivables ratio, that's what happens to this ratio. If you've included retainage in it, it does not have the same effect. However, that's a decision that you have to make, and you have to make with your clients and decide the way they want to go. I prefer not to have it in there because I never know when the retainage is going to come in, and neither do your clients and neither does the company. So That's why I don't include it. All right. So let's take the other situation where we don't have a great amount of seasonality and a great amount of different product mixes and billing crazy one month and, crazy every quarter, once a quarter that we talked about before the break. Let's assume that it is fairly consistent and fairly constant. And if that's true, then this trend line, at least the trailing trend line, should be fairly constant. If it is increasing and you start seeing the receivables to payables graph starting to increase, and there's no seasonality, and there's no retainage, and that's not a product mix, and increased billing or something along those lines for one-time shot type things, then it's a collection issue. And this also should be seen in the usage ratios. And your receivable days and your usage ratios in this particular case should go up because the company is not collecting. All right. It's not paying attention to collecting. So if you're seeing this and it's not because of, increased billing or seasonality or something along those lines, then it's time to have the collections discussion. And this is never a fun discussion, but it really and truly needs to happen because the company needs its money to be able to pay its bills. The company did the work, produced the products, whatever, and it's time for the customers to pay them. So the companies that pay close attention to collections are actually the ones who get their money fastest. If a company is sending out invoices and they're 30 days fine, it's time to make a phone call and find out when the company will get paid. If it's 60 days or 90 days before they make a phone call, the company on the other end is like, oh, they don't need their money, so I'll just take 60 or 90 days to pay them. And in the meantime, your client or your company could be headed for a cash flow issue and a cash flow problem. So always pay attention to receivables and collections. And I know it's never fun for anybody to have to pick up the phone and collect, but the reality of it is that you did the work, or your clients did the work, and it is time to get paid for the work that you did. So don't feel bad, or your clients should not feel bad about collecting, because it's really, really important, and making sure that the company survives because they need the cash flow. Some of the things that have actually made collecting get easier is putting a button on the websites of your company, simply because people can pay just by clicking a button on the website. They don't have to worry about sending checks. They don't have to worry about, it's basically an ACH payment at that point. And they don't have to worry about postage or anything else like that. It's quick. And it's becoming easier and easier and easier to do that. And the interesting thing is that we find that once buttons get put on the website, pay your bill here type thing, collections have a tendency to get faster and faster and faster. And some companies do it that they just do like a QuickBooks payment, or some companies do it where they can pay by credit card, or, whatever it is. But have your clients, or if you're a business owner, make sure that you put a collection button on your on your website so that people can easily pay. And you'd be surprised at how much faster the receivables do come in. So accounts receivable to accounts payable ratio is kind of tricky. You have to look at receivable days, which are the usage ratios. You have to look and make sure that the company, or, look and see if the company is a different product mix every single month or something along those lines. If the company has huge amounts of billing in certain times of the year, if there's retainage being paid, if they're a construction firm. So all of these things have to be taken into consideration when you're looking at these ratios. And if it's none of those things and the ratio's going up, it is a collections issue as a general rule. If the P&L graphs are going up and these graphs are going up too, it could be increased in sales. But you have to look at it and look at your aged receivables sometimes to see whether the collection issues are there and whether they need phone calls or, attention paid to them. So it's a little bit trickier, but it's something that you have to watch to make sure that the company has enough money to pay its bills. Um, I don't like to see receivables to payables ratios under 1. And if it's cash plus receivables to payable and it's under 1, the company is in trouble as a general rule. Remember that if we're looking at receivables to payables, we have to look at it receivables plus cash for companies that are more than 50% COD. And if the payables and the company's on QuickBooks, it has to be payables plus credit cards because QuickBooks puts them in 2 different categories. And so you need both because you have to pay your credit cards off every single month also. So if it's receivables plus cash divided by payables plus credit cards, and the number is under 1, profitable sales are the only way around that to be able to take care of that particular issue. So thank you for joining us. Choose one thing that you discovered and implement it in your business. These ideas, tactics, and strategies help you make more money, have more free time, and give back. If you like today's program, spread the word. Please review this podcast on any device you're listening to it on. Help a business owner improve the health of his company. For comments or questions, call me at 770-729-8000 or email rking@financiallyfit.business. Thanks for listening. Have a great and profitable day.